Hey traders, this is Blake Morrow with Traders Summit, and I have a very, very special interview with you today. It's not because, Jim, you are special. This is Jim Welsh with Macro Tides. I know you're a special guy, and I love our talks on Friday, but this is a targeted video that I really think is going to be very important for our listeners. So I want to thank you for taking a little bit of time. How are you today? Happy Friday.
Happy Friday back at you, Blake.
All right. Well, I want to say this. First of all, congratulations. It's Friday, but I think there's congratulations in order. It's you and your wife's how many years?
Oh my God, 43.
Happy anniversary to you and your wife. 43 years is
the main thing. We still like each other. I mean, that's like the greatest blessing. It's held up in like caged for 43 years with anybody. But to actually still enjoy each other's company.
I was going to say, it says a lot about you, but it really says more about her because she put up with you. So anyway, happy anniversary. Happy anniversary. Let's talk a little bit about these markets. The S&P, before we get into like the main topic, if you will, the S&P has been slammed back. It rallied to 4,100, really rejected the breakdown point, came right back down. We're near the the lows are below 3,900 as we are talking. We'll see how the market closes by the end of the week, but it's still pretty bearish. What are your thoughts here on the price action in the markets? And I know you brought a chart too. So what do you think?
Well, the charts are for the other section, remember?
Okay. Got it.
Just touch on it. My view, as you know, Blake, and as we've discussed, was that we saw a compression in the stock market based on higher interest rates, the 2-year and the 10-year and so forth. And that the next shoe to drop was going to be recognition that the economy is slowing, but yet the Fed is going to continue to hike rates because they actually want it to slow. And that Wall Street estimates for earnings for the remainder of 22 next year will start to come down. And I think we saw a trigger to that process with Walmart and Target this week, whose stocks got these are big name companies that have been around for a long time. They got slammed. And it wasn't because demand was weak. It was because demand had shifted. So they both had loaded up on appliances and furniture, things like that, the big ticket items. And people don't need that stuff anymore. They're going to services. And so it wasn't like the demand dropped. It shifted. And so again, but I think that sparked this process of, wait a second, there's a change afoot. And I think that's what's going on with the S&P. People are selling into rallies because it's like things aren't going to get better anytime soon. And, again, my expectation was 38.50. I think we're going to go below that, obviously.
Do you feel that way? Do you feel that way though?
Yeah. There's no, again, until the Fed can start talking about, and they'll do this. I don't think it'll happen before the June meeting, but before sometime in early July, I think we're going to see Fed speeches that start talking about, we wanted to bring slow demand. We're seeing signs of that. We wanted to see that inflation has peaked. We're seeing more evidence that is in fact happening. And that begins to shift the potential. And I think this is very likely that they will downshift after doing 50 basis points June and July, that leading up to the September meeting, they'll go back to like 25, because after another 100 basis points, they're going to be at 175 to 2. They're getting close to neutral. And that was the main message I try to write about, was the Fed is intent on getting near the neutral rate of between 2.5%. Yeah. And it's almost like nothing is going to stop them from getting there. But as they approach it, and they see these other signs that things are starting to curve in their direction that they've wanted to see happen, that they can downshift. It buys time to see then if the things they can't control on the supply side, supply chains, computer chips, labor market, begin to help them as well. So, but between now and then, I just think the market has this bleak thing of they're going to see earnings come down and Fed speeches are going to still be hawkish.
Okay, well, now I questioned a few other people that I've interviewed this week about the potential of them shifting rhetoric, even though they won't shift what they're going to do. using that policy tool of their words, if you will, or, parading around all these Fed members, of maybe even talking a little bit more dovish, but still acting hawkish, right? So the meeting's they're still going to raise rates, but it's kind of like when we were when the stock market was just rallying all the time, right? And we got this hawkish rhetoric, but the Fed never followed through with that hawkish rhetoric, right? They always failed to deliver, and that's where you lost that credibility, if you will. But maybe on the downside, as stocks are coming off and they want to try to burden or dampen the downside pressure, they could start talking a little bit more dovish, even though they're going to act hawkish. We would find out later. But that's kind of been my thought process. Do you have any opinions there?
I agree with it. I'm just saying is that window when that starts to happen is probably after the June meeting. Closer
to Jackson Hole, maybe?
Well, leading up to the July meeting, which is, I think, July 27th. So as we July 4th, there's a window, I think, of about 10 days before a meeting that they can't give speeches and so forth. So I just in that first half of July, if indeed the numbers come in, economy's slowing, inflation is starting to tick down a little bit, you'll see them talk about, hey, we're getting closer to our goals. That to me will be the signaling. They're not going to change, but in the meantime, again, I think they're going to go 50 basis points in July. They want to get near the neutral rate. So I agree with that. I just think the timing of that and the relief that talk will then provide equities, is still another 45 days away.
Got it. Okay. Well, now before we get into the topic that kind of spurred my interest in our conversation, before we get into that, I want to mention this: if you guys are following us at home in your home office, make sure you give Jim Welsh a big thumbs up on YouTube. If you're watching us on YouTube, just because, Jim comes out here every Friday to give his analysis. And by the way, you've been spot on, where the market rallied and rolled over to and how it's dropped below 4,000. You've been spot on. So folks, if you're watching at home, make sure you subscribe to the Traders Summit channel so you don't miss any of our content that we do every week here exclusively with Jim. But more importantly, give him a thumbs up to make him feel good, because I think you do a great job, and I'm sure everybody else appreciates it as well. So last week, you're welcome. Last week, we were talking and you said something that really, I actually had to text you afterwards and said, hey, you talked about a 2025 depression. What makes you feel that way? And then I came back and I said, you know what? Let's save it for this week, because this is that's a scary prospect for a lot of people. You look at Americans right now, you look at like what age group are they? I always lose track. The not the millennials, but even the group before them or after them, where they're priced out of the market. A lot of millennials are priced out of the market. A lot of 20-year-olds are. And then if you fast forward a couple of years and you're talking depression, let's discuss this a little bit. I want to know where you're coming from and where your head's at regarding this topic. So do me a favor, give us a little overview of what you're thinking.
Yeah. Well, there's a number of key things that I think are likely to come together. And it's not like they're going to turn a switch and in 2025 we're going to be in a depression. I'm not willing to go quite that far yet, but I do believe it's going to usher in a window of time where we struggle with a lot of issues that have built up over many, many decades. And that the stock market, much like between 1966, 1982, the Dow went from 1,000 in 66, and 1982 it was down below 800. So it went nowhere for 16 years. You had big swings. And I just think that something similar is going to happen. Although, as we'll cover, I think that this is a degree higher. In other words, a more significant sideways pattern, which means a pullback of 50% or more as that proceeds, I think is more likely. So again, it's a number of key things that are, I think, coming together. And first one is valuation, which is, using the Buffett chart, which is basically or Buffett indicator, is taking the stock market divided by GDP. And, the idea was, stocks represent, if you will, the inherent intrinsic value of our economy. And what you can see, Blake, going since 1950, it fluctuates above and below that trend calculation.
Yeah.
And so, you overshoot to both sides. Right now, it's at 175% of GDP. And this is, of course, after the recent 18% or so decline in the S&P. And if you get down towards just that line, the S&P would fall by 33%. So that, from a valuation standpoint, it just says, hey, at some point in time, we're going to either, GDP continues to grow and the S&P doesn't do a whole lot, like the 66 to 72 or 82 timeframe. And you can see that on that chart. From about 66, 68, there was kind of a double top there, all the way into 82. What happened to valuations? So I just think we're entering a period where a number of things can get together that will take over a 15 to 16-year time period, bring the S&P down valuation-wise to that line, in all likelihood, as it's done in the past, below that trend line. So again, there's two things. GDP can maybe continue to grow, but valuations come down for a lot of different reasons.
Okay.
So that goes into I don't remember the sequence of all these things I just put together yesterday.
Oh, the debt to GDP.
Yeah. Okay, so this is one of the big things, that debt has been growing significantly, especially since 1981, when interest rates peaked. The Fed funds got up to 20%. As it came down, it made it much more cheaply to be able to borrow money. But the main thing here, Blake, is you can see debt is growing faster than GDP.
Yeah.
That's kind of getting fat by eating your own leg. At some point in time, you're going to have mobility problems, right? And the bottom chart shows money supply. So as the Fed is injecting more liquidity to kind of get things going, it's like we're force feeding gasoline into the engine. Velocity measures how fast that money is turning over. And when velocity increases, you get an increase in GDP. And likewise, when it declines. So what we're seeing is more debt, more money getting jammed into the system, but velocity's been declining for 2 or 3 decades.
Wow.
So all like exhaustion type things, where each new dollar of debt is generating less and less GDP. $1 debt, and all of a sudden you're getting 30 cents of GDP. You can't go on that way forever. So that, to me, is a wall is coming, where there's going to be this recognition that we have to deal with this. And it's going to be painful, because the government has been sending out money, and we have so many people that are unfortunately dependent on government largesse in their everyday life, that it's just going to be really a difficult thing from a social standpoint. So I think the next chart is talking about GDP. How do we get there? And there's two main contributors to GDP. Labor market growth plus productivity. So we can look and see, when more people are born and then ultimately get to be 20 years old and beyond and go into the workforce, that's going to generate more income, more demand, and it spurs economic growth. What we can see is we got a multi-decade decline in population growth. And last year was the lowest birth rate year since 1937. And so it's been declining. So the point being is, you got to go out 20 years before you say, wow, okay, in terms of people being born in the US over the last 5 and 10 years, tells us what's going to happen to the labor market out the next 10 and 20. And it's going to be really slow growth. The second chart shows by a decade. Go back 1 second, if you could, Blake, I'm sorry.
Yeah, no problem. Let me get back over there.
Okay, so the bottom chart in this panel, shows what's happened by decade labor market growth, and you can see how much it's slumped. Visually, you see the mathematics behind it. Right. But then the Congressional Budget Office says, well, here's what's likely the next 30 years or so, and you're talking about 0.3, 0.4%. So in other words, labor market growth will contribute in the next 20, 30 years about 0.4% to GDP. Now we're ready for the next slide.
And that means we need to get those youngins. We should probably feed them some alcohol and throw them some parties.
Well, the other thing is immigration.
Yeah.
Boost domestic labor market growth by bringing people in. At the same time, there's a dumb way to do it and a smart way to do it. The smart way is to bring people in that have skills. So, all right. So productivity is the other component. And you can see this is a 5-year moving average of productivity. You can see how the swings have occurred over the last 70 years. So, can productivity improve a little bit? Sure. At the same time, when you look at the bottom part of this chart, it shows the combined GDP growth for these windows of time, like 50 to 72 was 4%, from 74 to 81 was 3.2. And then the graphic below shows, well, what contributed to it? How much did labor market growth contribute versus productivity, which is the beige color. So again, these are long-term trends. And unless we see some kind of a dramatic increase in productivity, what it suggests is GDP growth. It's going to be tough to see it grow above 2%. And that's what, you can see from 2021 and on. The Congressional Budget Office combines these two things, expectations of productivity and labor market growth. And you can see for the next 20, 30 years or so, we're talking GDP growth less than 2%. So you've got all this debt, and you can't get more GDP growth because the debt is already really high and the return on more debt is going down. And you've got these factors that say, you know what, it's going to be really tough to finance all that debt and get out of this kind of a debt trap. So my view has been that we were going to see a wave of inflation and then deflation. And, the jury's out on whether that's going to prove true. Let's go to the next slide. But I think that's the $64 question. All right. One of the other aspects is what's happened to us as a country. So you can see in the 1920s, there was a lot of discord between, if you will, the political parties. And then as the 30s evolved and the World War II and early 50s, we were brought together by first an economic period of hardship that was unprecedented. And then obviously a world war, the greatest war of all time. And it brought everybody together so that both parties were very focused on getting things done. They put country first, not political agendas. And now what we see is, hey, what drives both parties is political agenda. We can't get any compromise. Yeah. We don't get solutions, not even partial solutions to a lot of the problems that we have. We have wealth inequality, income inequality, but we also have federal government, passing an enormous amount of regulation that does have an impact on economic growth. But this divisiveness that we've seen, we had a pandemic, you would thought, hey, bring us together. Nope, it wound up being divisive. The issue of abortion, that's hugely divisive. So to me, what this suggests, Blake, is that we're going into a window of social discord that's even greater than what we've experienced so far. And we can go to the next slide. So there's a couple guys wrote a book called The Fourth Turning. That's below the chart there, 1997. It was written by academics for academics, so it's primarily really boring. But I kind of went through it and I found it pretty, somewhat fascinating. And what they found was, and they went back like to the 14th century in Europe, that there's a cycle back in those days, because things move more slowly, about 100 years. But within each window of cycle, there were 4 quadrants. And they dubbed them the high, awakening, unraveling, and the crisis phase. And what they found was people born in the high period, which is the 20-year period or so right after a crisis, have certain traits as do each of the other 4 categories. So the point they made was that they thought sometime around 2005, there would be an event, maybe a financial crisis, that would signal that we're in the crisis phase of the current fourth turning, which began in the mid-1940s. So again, look, going back, we don't have to go back to it, but referencing that chart that we just saw about political divisiveness. Well, in the 40s, we were so unified as a country. with one purpose in mind and together. And obviously now we're not there. So we're leading up, I think, to a crescendo. Back in December, I showed this chart in the Macro Tides monthly letter, 20-year cycle. And the expectation was, hey, we're likely to see a decent correction, because I was looking for a 10 to 15% pullback in the first part of this year. And part of it was because of this pattern. You can see every 20 years has been a low point. Now, 1982 is after, like I said, 16 years ago and sideways. But the other declines, then embarked very, very meaningful, rallies. Yeah. So I think this turning point that we're coming up to over the next handful of years is going to correct the rally, not just from 2007, but at least maybe 1982 and potentially 1932. So in other words, this is going to be a big one. And that's why I'm reluctant to use the word depression, but at a minimum, I think we're going through an extended period where somehow we have to work through all the issues that are on the table and become more cohesive as a nation and as a country. That doesn't happen in a year or two. That takes time, because you're going from a period of extreme divisiveness, and people almost have to be pulled and pushed, kicking and screaming, to, you know what? The fact that we're both Americans matter more than all this other stuff. And that ain't going to happen overnight. That's simple. And then finally, the last chart, everyone gets this idea that, hey, when the Fed cuts rates, that fixes all problems. And I thought it interesting to show, if you look at what happened in 2000, the bear market 2001 to 3 and 2007 to 9, the red line, or close to red line, is what they did with Fed funds. So the Fed slashed the federal funds rate. Look at the S&P was down 50% in the 2000 to 2003 bear market, and down 57% in the bear market of the financial crisis. So the point being is, the Fed, just because they cut rates, that doesn't necessarily mean the market is going to respond instantly. And I think we've had a tremendous loss of trust in institutions. I mean, it used to be where we did respect members of Congress. And again, in the 40s, hey, they were doing all the right stuff. No one believes that today. You look at the media. The media used to be what's called the fourth estate. They were kind of like the objective arbiter of what the politicians were saying. Well, that's changed. I mean, I grew up in the era of Walter Cronkite. And now we have MSNBC and Fox News dedicated to promulgating misinformation. Now, one group of people like the misinformation they get from MSNBC, and another group likes the Fox misinformation, but nonetheless, it isn't what the news used to be. Yeah. These issues that have come to divide us, defund the police and so forth. Well, gosh, 50, 60 years ago, prior to the awakening from 65 to 85, no one would have ever thought of calling cops pigs. Well, now we call them a lot worse than that, and we want to defund the police. We've seen criminalization rise significantly in our society. You can rob somebody with a knife or gun, and as long as you don't shoot them or stab them, it's a misdemeanor in a number of major cities. And lo and behold, what's happening? Hey, there's more robberies taking place. So we're seeing kind of a slow disintegration of our society, the cohesiveness. And so that's why I think, again, looking at it, that we could see a 15 to 20 year window of time, Blake, is because it's so many things that are integrated, and each one is going to have to find their own solution, so that ultimately you come back to where we were, let's say in the 40s and early 50s. It's just going to take time. And let me ask you this. I mean, I know it's hard to predict the future, Jim. And I try, as a trader, I try to just figure out what the hell is going to happen that day. Today, and it's tough. It's tough from day to day. But when you look ahead and you see like this culmination of what you've put together, it does paint a very dreary picture. But you've, in your past interviews and in recent months, you said, well, hey, we're gonna, sell off, get below 4,000. Then we're going to rally to all-time highs. Are you still feeling that way? I mean, because is it possible the Fed is raising rates right now,
But we get to a point where, the Fed says, we're going to have to turn into Japan and keep rates at zero for the next 20 years. And maybe that's what pole vaults the market to new highs. I mean, I don't know. I'm asking you what your thoughts are there. Do you still feel that same way?
Yeah, I think as long as the Fed doesn't have to go beyond neutral, the 2.5% rate, that the whole thing keys on whether we're going into a recession or not. All right. If we go into a recession, the average bear market decline is 36%. And I think that precludes going to new all-time highs. My thought was we'd get a correction and then we'd get this window of time where the Fed, and as we discussed in this conversation, can get to a place where they're going to slow rate increases and inflation starts to come down and all that. You're going to have one heck of a rally. And, the odds of it going to a new all-time high are less than they were 3 months ago. Yeah. But I think that is on the table, because if you get any hint that the Fed is going to downshift from 50 to 25 and inflation starts to, and some of the things they can't control, so you can have one heck of a rally, Blake, in a short period of time because of the speculative nature we saw last year. That muscle memory of, oh my God, I got to get on board. And, call buying out of the money calls and whoosh, by the first half of next year, we're at new all-time highs. And then potentially inflation doesn't come down enough. The Fed is forced to go higher, or globally, we go into a recession and it drags the US down, or there's some crap. I mean, like countries like Turkey, Sri Lanka, they're small countries, but they're teetering on the edge, a credit edge. So again, like you said, one day at a time. We first have to get through this decline that we're experiencing, but sentiment is already pretty extreme. I'll put together a chart next time. We can look at the weekly differential between bulls and bears and the investors' intelligence numbers down to, I think, -13. Those are really, really low numbers. We just need the Fed to take the foot off the neck of the market, if you will. And I do think that's coming. Then the quality and that next rally will tell us a lot, in terms of, is it going to be a bigger bear market rally, lasting 2-3 months and then over because we're going into recession, or the Fed's going to raise rates further? There's no way of knowing at this point. But
let's not forget, and I think it's you're giving people a stark reminder that bear market rallies, they can be big and they can be vicious. Yeah. And you have to be on your toes, especially if you're bearish in this environment and you believe, what Jim's saying, and you think, I agree, Jim, we're going into a depression. Doesn't mean the stock market doesn't always equate to the economy.
Nope, it really doesn't. It's more psychology. Think about it. In 1982, the average PE was 7. By 2000, it was 35. $1 of earnings. In 82, that company sold for $7. In 2000, it sold for 35.
And what are we right now? 16, roughly? 16, 17?
16 to 17.
Somewhere in that.
Maybe a little closer to 17.
So think about that, guys. And gals, I learned the hard way many years ago that the economy does not equate to the stock market. So just keep that in mind. The economy doesn't equate to the stock market. I want to make sure I said the right thing. It is Friday.
Got it. Yeah,
but Jim, I have to say, this is, I love your wealth of knowledge. I'm so appreciative to have you as a friend and to be able to sit down with you every Friday. If I'm a trader at home and I'm trying to figure out how do I follow you, Jim, how do I do that?
Macrotides.com. And as I've said in previous conversations we've had, Blake, if somebody would like to get the most recent weekly technical review, I'm happy to send that out because hopefully that'll encourage more people to do thumbs up and acknowledge the conversations that we're having. The next handful of years have the potential of truly being even more historic than the last couple of years, I think.
Whew, man, buckle your seatbelts, folks. All right. Well, Jim, I want to thank you for spending your time with us today, and I'll look forward to next Friday with you.
You got it. Have a wonderful weekend, Blake.
Do the same. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.